Hello everyone. This is iAPM lecture number 2 on financial markets. Now, what are financial markets? Financial markets are a component of investment environment. They are designed to allow corporations and governments to raise new funds and to allow investors to execute their buying and selling of orders. A financial market is a set of arrangements that allow trading between buyers and sellers. They are the participants. Now, financial market provides three important economic functions. What are they? One, financial market determines the prices of assets traded through the interaction between buyers and sellers. 2. Financial market provides the liquidity of the financial assets. And 3. Financial market reduces the cost of transaction by reducing explicit costs such as money spent on advertising. Financial markets can be classified based on the above into a sequence of transactions for sellers and buyers, term of circulation of financial assets traded, economic nature of the securities traded in the market, and from the perspective of a given country. Then you have a primary market and you have a secondary market. Primary market is where the company issues shares through an IPO, initial public offering, to the investors. And you can also have where the price is not mentioned, you will have a red herring prospectus based book building process, IPO. Okay. Then you will also have in primary market, you will have underwriters who will underwrite the non-completion of the transaction. If the full shares that are offered are not purchased by the market, then the underwriters will take it for a fee. So that every company which comes to a stock market onto the public for IPO will go back with a completed transaction. We will make sure of that. Next is the secondary market. Secondary market is a stock exchange. It will be working through a broker. Now we have two major stock exchanges in India, National Stock Exchange and Bombay Stock Exchange. Okay, then you will have among the brokers, every transaction has to go through a broker in this National Stock Exchange or Bombay Stock Exchange. Now these stock exchanges have got three types of brokers. One is a discount broker who does only trades on the second market. Then you have a full service broker who will give you advice to buy or sell or pricing, vagara. And then you will have an online broker who only executes the orders which are given online, that is through the internet. Obviously, if your services are less, then your charges are less. If your services are more, then your charges are more. A full service broker will charge anything up to 2.5%, whereas online broker and discount broker will charge anything between less than 5 paisa to up to 2% or 1% by that. Now, types of secondary markets. We have organized security exchanges like Bombay Stock Exchange, National Stock Exchange. Then OTC markets are there for foreign exchange. Then you have alternative trading systems. But in India, we have mainly NSE and BSE. Now, what are the exchanges? What is the role of exchanges in a modern economy? One, it will give you a supervision of the trading to maintain its fairness and efficiency. Then it will give an authorization and it will regulate the brokers and market makers. And third, it will create an environment in which security prices are discovered efficiently and without any distortion. Whenever there is a distortion, they will stop trading and start again when without distortion is there. Then you will have an arrangement, a company, a corporation for clearing and settlement of transactions. Because stock exchange does only trading. The clearing and settlement with the banks and others has to be done by another corporation, which will be a central counterparty to all the buyers and sellers. The regulation of admission of companies to be listed, there will be a listing agreement, there will be a requirement of giving information as much as required. Okay. Then you will have dissemination of information, trading data, prices, announcements, information, analysis. All these things will be done by the stock exchanges. Then you have over-the-counter market. It is not a formal exchange. We in fact actually had a formal over-the-counter exchange of India, but it failed to take off and it was closed. So over-the-counter curb deals, they are called in normal parlance, they are called curb deals, which are done outside the market timings by people, and then they are later on brought into the normal exchange. But the rates will be decided by the OTCs. Then you have alternate trading systems. What is alternative trading system? It's an electronic trading mechanism. Okay, like security exchanges, matched buyer and sellers are matched. So such things. What are the financial assets traded? Now we have a money market, we have a capital market. Now what is the difference between the money market and the capital market? Now first, based on the term of circulation of securities traded, money market is short term, less than 1 year. Capital market is long term, more than 1 year. In the case of level of risk, Money market is low because you trade in short-term securities. Capital market is long-term securities. It's more risky. And fund suppliers, in case of money market, is commercial banks, non-financial business institutions with excess funds. And capital market is banks, insurance companies, pension funds, lending large amount of money. Financial instruments, money market, it is certificate of deposit, treasury bills, commercial paper, banker acceptance, repurchase agreements, repos, and other short-term investment vehicles. In commercial markets, they trade in common stocks, preferred stock, treasury bond, municipal bonds, corporate bonds, other long-term investment vehicles. And aim for raising money in a money market is financing working capital and current needs or only deployment of cash. In capital market, it is financing of the further development, investment in big projects and things like that. By economic nature of securities traded in the market, you have equity market or a stock market, and then fixed income market, and a debt market, wholesale debt market or retail debt market, and derivative market. Then you have internal markets and external or international markets. Okay. So then let us next lecture we'll say about investment process. Thank you.